Welcome to day 42 of me backtesting my way to success. Let's just get right into the charts. First trade was a loss, and the reasons why I entered were this 2-hour order block right here, equilibrium from the swing high to the swing low, and a break of structure. And I think actually the reason why I lost this trade was because there was this huge 2-hour fair value gap right here, and price barely went into it right here. I was considering about entering off of a break of structure, but it like just dipped into this fair value gap. Like this fair value gap was this huge and it just dipped into it like this, and so I didn't enter. And I think actually the equilibrium got already used with that fair value gap, and so yeah, I think that was the reason why I lost. Stop loss was about the order block. Take profit was the beginning of this 3-hour fair value gap. Let's just see how the next trade goes. Next trade was another loss, and the reasons why I entered were this daily fair value gap right here. Equilibrium from the swing low to the swing high, since we're currently going up, or since we were going up, and a break of structure in the lower time frames. Well, I guess you could also say, because I entered right off of this candle, this one right here, and you could say that it was a sweep of this area, as you can see right here. Just before I entered, it swept this area of liquidity. And what I actually learned from the last couple of days was, when something like this happens, at least with an order block, like if the area of liquidity from below the order block gets swept, then the order block is actually getting invalidated or ignored, and price is just going to go even more into the direction it's currently going. And I guess I missed that. I didn't know yet that it was the same for fair value gaps, but it makes sense actually. And so I guess that's the reason why I lost. Let's just see how the next trade goes. The next trade was a win, and the reasons why I entered were this daily fair value gap to the upside right here, 3-hour order block right here, equilibrium from the swing low to the swing high, and a break of structure in the lower time frames right here. It made a lot of sense, and that's why I entered. Take profits with previous areas of liquidity right here, and also of course the this area of liquidity, since that's the swing high from my equilibrium. Both take profits were hit. Let's just see how the next trade goes. Next trade was another win, and the reasons why I entered were this daily fair value gap right here, 1-hour order block right here, which I didn't see at first. That's why I almost entered right here off of this break of structure in the lower time frames. And yeah, of course, break of structure, just like I said. Take profits were this 4-hour fair value gap, or like, yeah, the bottom of this 4-hour fair value gap, the bottom of this 4-hour order block, and this area of liquidity. Stop loss was below the 1-hour order block. And yeah, I entered off of a break of structure, just like I said, in the lower time frames, right? The candle right next to my cursor. And yeah, all take profits were hit, pretty huge trade. Let's just get on with the weekly recap. It's that time again. So on day 36, I learned to place a better stop loss, because I think I was giving my stop loss like this much breathing room usually, and that's just way too much in my opinion. Then I also wrote down that I should trade with the bias, because sometimes I still trade against the daily bias, because in the lower time or in the lower higher time frames, so 1 hour, 2 hour, up to 4 hour, they are saying that we're in an uptrend, for example, and the daily is saying we're in a downtrend. And so sometimes that gets me confused, it seems. And also to not enter when the stop loss feels awkward, you know, just because I didn't enter like around here on a break of structure, because if I had placed like stop loss like right here, then it would have just been awkward to place it like in the middle of this daily fair value gap, while there was also a confluence below the fair value gap. And I should also pay attention to the wick. So basically I should pay attention to what a candle tells, because like, as you probably already know, if there's, for example, like this kind of a wick with this kind of a candle with a long wick to the downside, then that means there's a lot of buy pressure, and that price is, at least based off of this candle, going to go further up. And that's exactly what happened. But of course you can't base that off of one candle alone. And so yeah, the next day I learned again to be patient, and once again to not enter a trade when a confluence feels awkward. So okay, not once again. On day 36 I wrote to not enter when a stop loss feels awkward. On the 27 I learned to not enter when a confluence feels awkward. And I think this awkward feeling that I get is just legit market experience, just my gut telling me that I don't think this fair value gap is valid, for example. So yeah, I should definitely trust it. On day 38, I wrote to trust my gut, and in brackets, well done. I think it was the day where I got 10 wins and not a single loss. And so yeah, I was also not entering certain trades on that day because, again, it felt awkward, and so I trusted my gut, and it also paid off. So yeah, that was a pretty good day. On day 39, I learned, or I wrote down, that I should again look at the buys before entering. It seems that that's a relatively huge problem for me, because I wrote it down a couple of times in this last, I don't know, 6 weeks. And so yeah, should definitely still work on that, just like the impatience thing. On day 40, I wrote down that I should not enter when the liquidity from an order block gets taken out, because I actually watched a video from a friend of mine's. He does YouTube too, but he doesn't know that I do YouTube, but I know he does it. Because I'm not that serious about it. I want to learn trading, and he's focused on YouTube. And he said something about minor and major liquidities. I have not fully understood it, but I think it was something along the lines, because when the liquidity from below the order block gets taken out, then even if it's just like if it's just, for example, if there would have been an area of liquidity right here, and price went out of this order block to take out this area of liquidity, then it means that the order block gets ignored, and price is going to go further in that direction. At least that's what I found out on day 40. Yesterday I learned to not enter when under time pressure, and I think it's best actually for me that when I'm under time pressure and I can't find anything, that I'll just do an update, an outro right away, because it's better than to enter a stupid trade because I want to fill 5 minutes of each video, if however not there's like no one watching my videos, so I don't even know why I'm doing this. Like, I don't know why I'm trying to fill 5 minutes. It's kind of stupid, but yeah. And today I learned the same thing with the order block, but now I learned it with the fair value gap, and I think I'm going to apply it for every confluence, because it makes a lot of sense actually. If the liquidity below or above, which depends on the trend, above or below the order block or fair value gap gets taken out, then the price will continue in its direction. It actually makes a lot of sense. So that's already it for today's episode. We'll see you in the next one.